Okay, welcome to the On Your Side podcast. I'm Gary Harper.
And I'm Susan Campbell.
Can we just talk about the traffic, first of all? Just get this off my chest.
Get it off your chest. I scheduled an earlier podcast than you typically enjoy.
That's okay. I mean, I love doing the podcast. I love today's topic. But before we jump into it, it's just like there's a window there. Like if you drive on the interstate before a certain time, and I believe that certain time is before, say, 6 o'clock, maybe 6:30. But anything after that,
all bets are off.
I mean,
how long did it take you to get into work today?
About an hour and 15 minutes.
That's brutal.
Yeah.
You do not live that far.
Yes, I do.
No,
yeah.
But I'm saying,
I know.
It shouldn't take that long. That's brutal.
Right. In my normal trip in, it's usually about 30 minutes.
Yeah.
That's it. But
more than double it.
Today it was a parking lot. Oof. I was looking at my speedometer. It was 18 miles an hour, 18, 0, 18.
You need to come join all of us East Siders.
Well,
East Valleyans.
But we have talked about that before. You're just as far east as I am west.
Yeah.
So that's not really
there's more highway systems to get around over there.
And even if I was out there, we couldn't carpool.
No. Not unless you wanted to start your work a lot earlier.
Yeah, you get in real super early.
No, I have the best shift in the building. It's a secret. I don't want anybody to know how good my shift is.
Yeah, because
I start at 6.
Yeah, and you have that window too, because if you get past a certain time,
if I leave my house a minute after 5:15, then it's never like bumper to bumper traffic, but it definitely builds up. And then all of a sudden my 30-minute drive becomes 45. And now I'm cutting it pretty close to when I'm on TV.
I love the GPS nowadays. They tell you where there's an accident. And
just avoid it.
They tell you where there's the fastest routes, how much faster it is.
Good.
So, that's our, I guess, AI that's working for us, right?
Yeah.
Hey, listen, we're talking about finances today, interest rates, loans, all kinds of stuff. And we've got a really interesting survey done by Bankrate. So we're talking to Sarah Foster. She's from Bankrate.com. And you're joining us from Brooklyn, right?
Yep, over in Brooklyn, New York City area. Thanks for having me.
Yeah.
She knows a thing or two about traffic. She's listening to us and going, nothing.
Yeah. I bet you do a lot of public transportation or not?
Yeah, public transportation. But, those one instances when I am in a car, it's pretty brutal with all the traffic we have here, too.
Why would you
I totally get where you're coming from.
Yeah, why would you ever take your car? I was in Chicago and D.C. recently with my son, and we did public transportation everywhere. He was like a little tour guide for me.
Just zipped around.
Oh, zipped around. Yeah. He knew what to do, the buses and the trains and all that stuff. Everything. So it was cheap too.
Yeah.
So
there's a lot of satisfaction when you figure it out. So.
Yeah. If you figure it out, it's well worth it. Hey, you did this survey recently, and it had some, I guess maybe some surprising results that Susan and I are kind of having a difficult time kind of digesting the numbers and what you found out. So tell us about this. What did you find out in this survey?
Yeah, so I focus in my role as an economy and Federal Reserve analyst, which is a very complicated topic, but my job is to really try to sum up what all of this means for consumers. And credit denials is really one of those side effects of what the Federal Reserve has been doing, which is raising interest rates to slow inflation. And so we found that since the Fed started raising interest rates in March 2022, half of those who've applied for either a loan or financial product have been rejected. And then 17% have actually faced more than one rejection. So I think when you really kind of put it up into terms, when the Fed raises interest rates, it could make it potentially harder for you to access the credit you need to pursue major financial milestones, just as an example. I think that really is just one way to kind of demonstrate the impact.
What kind of loans are we talking about that people have been actually denied, or financial products?
Well, it's really kind of the whole gamut here of loans and financial products. We actually saw that of all of the loans or products, credit cards are getting denied the most frequently. So 19% of those rejected applicants were denied for a credit card. That included new credit cards as well as balance transfer cards. Balance transfer cards are really that great way to pay off debt. So that kind of was a red flag for me. Could these denials potentially be making it harder for Americans to pay off debt? But when it comes to kind of the other loans, we're seeing personal loans are getting rejected, auto loans, auto leases, mortgages. It was slightly less, 5% of those rejected applicants say that they were denied for mortgages. But really, any kind of loan that you pursue, we're seeing tighter credit here because of the Fed's rate hikes.
And we were chatting a little bit. I mean, those are people who believe going into it that they're going to get approved. You don't really apply for a mortgage loan without thinking I've got this is going to happen.
Yeah, I'm going to do this. Yeah. What's the reason behind the rejections?
Well, we asked Americans if they were denied specifically because of their credit score, their credit history, or their income. So really that, major rating, which comes from FICO, Vantage, there's lots of other ways to evaluate your credit score. But that's really what kind of follows you around when you're applying for these loans or financial products. And I think that was really evident because we also saw that of the applicants that were getting rejected most frequently, it was those individuals that fall into poor credit categories, fair credit categories. But maybe surprisingly to me, we still saw that more than half of those with good credit were getting rejected. So I think your credit score really is the best way to kind of evaluate your chances of getting approved. But when the Fed is raising interest rates, it might make it potentially harder for some of these even credit-worthy applicants too.
Is it looked upon as being a risk to these credit card issuers or these loan providers? Why would they reject so many people because of the interest rate?
Yeah, so rejections really do come back to that, cost of financing. Ultimately, a lender does want to be paid back. That's their goal. When the credit score that a borrower has, that's really the main way of kind of assessing that risk of loaning the money out. And when we see these higher interest rate environments, I think I especially look at the housing market, for example. When mortgage rates were at a record low back in 2021, the cost of financing a $500,000 home would have cost just about $2,100 a month in principal and interest. Today, because of how much higher interest rates are, it's a 62% increase. So $3,400 a month now today. For that same home that someone would have bought, over 2 years ago. And I think that really demonstrates here kind of the crux of the issue, because when that monthly payment gets so much higher, you ultimately then need more income to afford the same good or the same asset. And when you need more income, that really just requires more documentation that the lender is looking for, and really a better maybe debt to income ratio too.
Wow.
That is a brutal stat when you actually look at that amount of money, because I mean, $2,100 to $3,400 in a month dramatically changes everything for a family.
It really kind of changes the home that you're looking for, because if you want to stay around $2,100 a month, you're going to have to go from a $500,000 home, and you're going to have to settle for something maybe $300,000, a lot less. So you're getting probably a lot less bells and whistles. There's not going to be a pool. A lot less square footage.
Yeah.
So
when you are looking at all of this, are there tips or tricks or any kind of magic silver bullets where people can kind of guarantee a yes to a loan request?
Yeah, so I often tell borrowers that the Federal Reserve might impact you more than any other policymaker in Washington, but what impacts you even more than them is your credit score. Really concentrating right now when credit is tightening on improving your credit score, that's the best step you can take. But it's difficult because obviously this is a journey. People spend their entire lives improving their credit score. It's not something that you just wake up one day and you're magically in that exceptional category. But I think a lot of the steps that you can take, they lead you in the right direction and they do pay dividends. I would say to borrowers right now, if you have debt, it's number one, it's really important to concentrate on paying that off, because credit card rates are at a record high. That really makes the cycle of debt harder to break when you have credit card debt. But if you're wanting to apply for other financing, it's exceptionally important right now to find a debt payoff plan. if you can get approved for a balance transfer card, make sure you utilize that. Find, what the 0% interest rate offer is, how long you have to pay off that debt. That'll really help you, as will bolstering your income, because like we were talking about earlier, that debt to income ratio is really important when the lender is evaluating your application.
What are some other things to do to improve that credit score?
Two other kind of pillars within your credit score that are important are making sure that you're paying your payments on time. So credit history, one reason why lenders really like to see that built up over time is because they want to see how you've been managing the outstanding debt that you already have. I often say that although we wouldn't really want someone to make the minimum payment on a credit card because that ultimately means they're carrying a balance, which again, that's the worst kind of debt to really have. Making the minimum payment on time is probably the most important priority. Your credit utilization is that second pillar. Making sure that you're not utilizing more than 30% of your available credit will help make sure that your credit utilization, that category of your credit score, isn't ultimately dinging you.
Yeah, I think it's important to just kind of reiterate, you have to pay at least, even if you're just dead broke and you can't make your payment, pay the minimum, because you don't want to fall behind. You don't want the penalties, because they really rack up quick.
Oh yeah, that makes the interest seem like chump change compared to the fees and penalties.
Right. So you need to make at least the minimal payment just to kind of stay current, and then do what you can. When it comes to demographics, is there one certain group of people that really are affected by these loans being denied? Are the younger generation, middle age? What are we talking about?
Yeah, two groups really stood out to me when I was evaluating these results from the study. Younger generations, Gen Z and millennials, about 6 in 10 of those applicants were rejected. That was versus about half of Gen X and a third of baby boomers. And then we also saw that parents with children younger than 18 were more likely to get rejected than adults without children, and then adults with children over the age of 18. I kind of, was puzzled by this. I was thinking, why could these groups maybe be seeing a harder time getting credit? I think a lot of it does, maybe especially for those younger generations, come back to credit history. They're still getting their lives started. Maybe they haven't hit their peak earnings years just yet. I think student loan debt is probably also part of this conversation, but when it comes to parents with children under the age of 18, I think this is a really important kind of category or demographic to focus on, because we also know that these groups were definitely hit by inflation, maybe even harder than other groups, just because of how much childcare costs soared after the pandemic because of labor shortages in that sector. Groceries, household essentials were more expensive and were greatly impacted by inflation. When you have more members of your family who you have to care for, I think during eras like now when inflation is still sticky, that makes it all the more dire. As we also know from other data from Bankrate, that a lot of Americans, especially parents and even some low-income Americans, have had to take on credit card debt to make room for inflation. It's almost like this cycle. I think about the cycle of debt really as being especially challenging in this era that we're in.
I believe the feds have raised the interest rate 13 times in the last 15 months, Sarah. That's an incredible number. I don't think it's been done like that since the 80s, maybe 1980s, well before you were ever around, Susan.
Oh, that's not true, but thank you. I appreciate the compliment.
I'm just going to go off topic here just a little bit. I mean, they're meeting in March this month again. What are analysts out there saying? What are they predicting the Fed is going to do with these interest rates?
Yeah, so interest rates, the Fed has raised rates 11 times, the highest interest rates since 2001, the fastest surge in interest rates really since the 80s. I think the way I would describe what the Fed's probably going to do in March is, was similar to an airplane being in a holding pattern. The plane hasn't landed yet. Inflation hasn't yet hit their target. They would still like to see prices slow a little bit more. But they are also admitting that, they have seen great progress on bringing inflation down, which is something to celebrate considering the job market has remained relatively stable. Unemployment is still low. But I think what the Fed would say is that they're likely going to cut interest rates this year, but it might be later rather than sooner. So for these Americans who are probably, wondering when it could get easier to access credit, I would say that could be a big deal breaker here soon.
I was the analysts that I follow all are saying like around June when they meet in June. I mean, we don't have a crystal ball, so we don't know. But for people, and I'm going off topic, and tell me if you're not comfortable answering this. But if the Fed does lower it a quarter, 0.25. What's that going to do to the real estate market? Is that gonna cause a major shift to get people in the market, or is that going to have any effect at all?
It's difficult, and I'm glad you bring this up because it's a huge topic kind of on our mind right now. Obviously, we know that something that's keeping prices expensive in the real estate market is low inventory. A lot of Americans would really not want to trade that 3% mortgage for something that's currently right now above 7%. So if you do maybe see mortgage rates dip a little bit, that is a fear. If maybe that will spur more housing activity that could push up prices even more. The way we're kind of looking at it, though, is that mortgage rates will gradually fall throughout the year. And it's a little bit of a wonky way to describe it, but the Fed doesn't specifically influence interest rates, but they're just one of the factors that the Fed doesn't specifically influence mortgage rates, but they are one of the factors that kind of have a play in it. So we could see mortgage rates fall even before the Fed starts to cut interest rates. But the way we are also saying it is that it might not really be that drastic of a difference. And so I think the ultimate question is, at what level do mortgage rates have to hit to unlock some of that supply? Because that could also be good for home prices too, at least helping borrowers or helping prospective home buyers at least find opportunities to jump into the market.
Yeah, I think a lot of people have been priced out right now, and everyone's just sitting on the sidelines, just waiting to see what happens.
Yeah, absolutely. I'm curious, when you were doing this research, if you found that the people who were getting denied were just way overestimating the debt they could take on, or if these were like small kinds of loan balances, balance transfers or whatever that they were asking for. Like, are we talking about a giant amount of money, or are we talking about something that's, small, $1,000?
Yeah, it's difficult to say because we didn't pull respondents specifically on kind of how much they were seeking to borrow. I think while we did find that half of applicants were rejected, a lot of applicants, maybe they fix that application, maybe they pay down some of that debt and they reapply and get approved. That's something that could be happening here too, that our data didn't necessarily reflect. But I think it's an interesting point too, because sometimes lenders will deny applicants for the loan amount that they're applying for, but then they'll offer them a lower amount. So not necessarily a rejection, but maybe a compromise between the lender and the borrower, the way I would put it.
If you apply for something and you are rejected, does that end up on your credit report? Can other lenders or potential lenders see like, one bank already doesn't want to work with Susan Campbell. We're going to pass too.
I get this question frequently, and while the denial doesn't necessarily hurt your credit score, a lot of the things that do hurt your credit score are those inquiries into your credit report, which anytime you're applying for credit and a lender is looking at your credit score, your credit history, that will show up on the report. So it's not necessarily the denial, but if you are applying for loans frequently, that could ultimately end up hurting your report.
Yeah, if you got like 3 credit card companies and then you get to you rejected twice and then you get to the third one, and the third one's going to say, they've already had 2 inquiries.
Something went weird here.
Yeah, something's going on here. Hey, Sarah, great conversation today. If people want to find out more about you or Bankrate.com, where do they go?
Yeah, a great conversation. If you want to learn more about our research, you can go to Bankrate.com. You can find this study. You can find my author page and read more about kind of where my expertise comes from and see other studies. We love looking into how the economy impacts people. This is our really great and fun, important job too. We're very passionate about it.
Yeah, well, sounds good. And yeah, Bankrate, certainly a friend of the On Your Side podcast. You guys are on here all the time with great information. And today is certainly the case. So thanks so much, Sarah Foster, for being on the On Your Side podcast. And have yourself a great day in Brooklyn.
Thank you so much. You too.
The On Your Side podcast is produced by Brad Denny. Our audio engineer and editor is Todd Martin. Segment producer is Colin Stanton. And I'm Gary Harper.
And I'm Susan Campbell. If you have a problem you can't resolve, maybe we can. Send us a message through azfamily.com or our AZ Family mobile app. Look for the On Your Side section and leave us a message. Thanks so much for listening to the On Your Side podcast. And if you like it, leave us a review. We'll see you next week.
On Your Side is on Good Morning Arizona every weekday morning at 6:45 and 7 o'clock. And every weekday evening on Good Evening Arizona at 4 and 5 o'clock. You can also catch it on Arizona's Family News at 9 on 3TV every weeknight.